Good evening. Welcome to Japan Society. I am Moto Sakurai, President of the Society. I am very pleased to welcome you to the discussion on artificial intelligence in the financial industry. The speakers will discuss current application of AI in finance and its future implications for the financial services landscape. Before we begin, we'd like to thank each of the sponsors that make this business and policy program possible. Global leaders, Citi, Deloitte, and United Airlines, and corporate partners, Mizuho Financial Group, and Toyota Motor North America. Now it is my pleasure to introduce today's moderator, Mr. Robin Wigglesworth. Mr. Wigglesworth is currently the U.S. market editor of the Financial Times. He is in charge of covering financial markets and asset management across the Americas. So without further ado, ladies and gentlemen, please join me in welcoming Mr. Wigglesworth to the stage.
Hello, everyone. Thanks for having me. I don't know if this is on yet, but I can probably talk here. It's a huge topic we're discussing, and we've got fantastic panelists here. I'll introduce them in a second. I just wanted to set the scene a little bit, because it's easy to get caught up in the hype and forget that this has actually been around for a long time. In 1958, a researcher called Frank Rosenblatt invented a machine he called the perceptron. It was one of the first neural nets, though before we actually call them neural nets. And it was actually so advanced at the time, in 58, the New York Times reported that the Navy, who was funding the research, thought that this was a machine that could in time learn to walk, talk, see, reproduce itself, and even be aware of its own existence. AI. But of course, as we know, the perceptron went nowhere. In fact, there have been a series of waves of enthusiasm about the technology, followed by what people call AI winters. But I think it's undeniable that we are now in the middle of an AI spring. In fact, it's blooming all around us. So we've got a fantastic few panelists here to discuss whether this is a durable spring that will lead to a summer, or whether we're going to head into another winter. What are the pitfalls and what's the potential of all this? I'd like to welcome to the stage Christina Chi, who's the co-founder of Domeyard, and Pawan Wadhwa, an old contact of mine from London, actually. He's a managing director at JP Morgan. And Gautam Moorjani, who's a client service principal at PwC. So if you can come and join me up on stage, we can maybe lift the screen.
Oh, sorry.
Sorry. Yeah. So to get us started, I thought I'd mention another episode in some of the history of machines I think is really fun. As we all know, that one of the things that's hard to avoid is talking about how AI is going to decimate the workforce. We're all going to have our jobs taken by algorithms. But in 1932, there was a British inventor called Harry May who invented a robot called Alpha. And this robot became world famous in 1932 when it suddenly came alive, grabbed a gun, and shot May. And he survived, luckily, but obviously Alpha the robot became famous around the world. There were stories around Missouri. It was one of the first of War of the Worlds panics about what machines could do. Now, obviously, poor Alpha was viciously slandered by the terrible journalists of the popular press. Alpha was innocent. It was this Harry May who'd tried to put a gun into its mechanical arm, shot himself, or frankly just burned his arm, and decided to exaggerate the story to show how machines were so dangerous and we should be worried about them. Obviously, no robots have come along quite yet, but clearly there is a lot of talk about artificial intelligence right now. So I'd like to maybe start with you, Gautam, and maybe ask you, why is there so much hype about AI now? Why are we hearing so much about it again?
I think that's a great question, right? I think it's similar to a lot of questions that I hear from outside as well, and I think there's a few things all coming together, right? The perfect storm, so to speak. I think there's the way I look at it. There's three things that have progressed quite a bit to this stage. One is clearly what's happening with the compute power, right? So the reality is, and my colleagues are much more educated on the specifics of data science, but if you think about analytics and predictive analytics, those have been around for a long time. It just took a long time to process a lot of data, and the computing power has significantly improved to where you can do a lot of these things real time, right? And so that's one thing. If I think about Google Maps, and when I go down for lunch, it immediately recognizes what time it is, it knows what my patterns are, and it's crunching all these numbers behind the scenes, and it tells me it looks like it's lunchtime, here's some restaurants for you, and it goes even one step further, and it can tell me that here's some cheap eats, because it knows I never spend more than $11 on lunch, right? So no developer had to sit there and write that code. It inferred that from the crunching that it could do of the numbers that were behind the scenes, and it didn't take days and weeks and months to run some of these models. And I think that's one big thing that's happened that we take for granted, but it's happening real time, right? I think the second thing that's happened is there's been a lot of use of the technology in practical ways. So this is one way that I describe, but the way I describe is not going to be life-threatening, right? So if it recommended a wrong thing, or if it recommended me a lunch place.
Some restaurants are pretty bad, though. So.
But, okay, point taken, right? So, but if it, for example, if I went down at 6 p.m. and it said, hey, it looks like it's lunchtime, I'm not going to do anything. I'm not going to throw my phone, or it's not going to do harm, right? So where companies and firms have been cautious, especially in the financial services space, is what if that error is $1 million error where a payment gets authorized or something happens? So I think the technologies have progressed enough to the point where there's checks and balances that are built into that, not much different than the checks and balances you put in for a human, right? And that you would check before $1 million payment went out, and I think so. That's the second thing that's happened, and there's been practical uses where people have taken that risk and put it out there. And I think the third thing that's happened that's kind of brought all this to a head is all the things we're seeing in our consumer life, right? That's happening. And I'll touch on, and I'll stop and give my colleagues a chance. I spoke at a career day for middle school, for my daughter's middle school, and one of the kids asked me a question, don't you feel bad that you're going to be putting all these people out of jobs? And I didn't even have to answer, because one of the other kids said, what are you talking about? You know, washing machines, dishwashers, vacuum cleaners, all these things were invented, and the kid had read an article that average chores in the household had gone from 49 hours a week to 9 hours a week as a result of all this advanced technology. And he said that didn't put people out of jobs. It created new jobs for repairmen and people that make the hoses and the belts and the Roombas and all these other things of the world, and actually spurred innovation. So I didn't even have to answer. The 12-year-old kid answered for me, right? So I think those three things are all kind of coming to a head that's allowing us to embrace this more, and we'll see more and more of that happen. And I hope it'll be not the winter, but we'll move into the summer.
Okay. But Pawan, I'd be interested, I mean, one of the things that I stumble over occasionally, and I've spent a fair bit of time reading about this, are the different types and fields of artificial intelligence. So under that broad term, I feel there's some stuff that just gets jammed in there, but it's basically just advanced statistics. But what's the difference between machine learning, deep learning, reinforced learning, or let's say natural language processing? So there's a lot of things under the whole AI field, right?
No, absolutely. I mean, you know, if you look at machine learning, for example, that's a subset of artificial intelligence where you can actually have the machine or the computer, so-called computer, you know, learn from previous data without explicitly having to program it. And now this stuff has existed for a while now, you know, and there's a wide spectrum of methodologies that you can use within machine learning, ranging all the way from what we traditionally call regression techniques, which are very, very simple statistical techniques, all the way to, you know, deep learning or neural nets, etc. Now, the definition of machine learning is kind of vague. Nobody really can arrive at a clear definition of machine learning. And it can encompass pretty much, like I said, a wide range of methodologies. Now, my own view is that, you know, you can certainly call a regression technique as machine learning, but that's really a fancy name for a very standard methodology that has existed for literally a century.
Yeah.
When we started our company, actually, we used to call it linear regression. This is before machine learning was a buzzword. We called it linear regression. If you open any machine learning textbook today, the first 4 chapters are on regression analysis techniques, which has been around since the 19th century. It's been around for centuries, and it's nothing new. It's just the reason why there's such hype around AI and big data, machine learning right now is actually, in my view, one of the reasons is actually because of data as well. If you think about it, over 90% of the data that exists today was created in the past 2 years. That's a lot, right? Every day in the opening hour of the New York Stock Exchange, our company, we process like 350 million messages just in 1 hour, 350 million, messages going back and forth. That's a lot. And back then, maybe 10 years ago, a server wouldn't be able to handle that load. It's a lot of data. But today, because once again, the computing power, going back to that, one server can handle a lot more load. And so thus we're able to do high frequency trading with a lot less than, we used to. And the cost has definitely gone down over time. And so thus, you see a lot more startups these days. You see, all kinds of companies that are starting to go into the AI machine learning world.
But I mean, to what extent, like you say, if we're just sort of dressing up old techniques with more powerful computers and new fancy words, how much of this is really new and how much are we sort of pushing the envelope these days?
I think the applications are still yet to be discovered, to be honest. You see a lot of big data implementations in our hedge fund industry. One example is, you see a lot of textual news feeds. So like Bloomberg, in recent 5-6 years, they started releasing more and more textual news feeds, which is basically you read, you're using ML techniques to read an article, a headline, right? And they determine the sentiment, is that positive or a negative article? And based on that, you can determine which stocks to buy or sell. But the question is, well, how effective are these, these tools, right? Because tools are a means to an end. There's startups out there that use satellite data these days, right? They use satellite data to look at oil rigs, and you look at the height of the oil rig in different countries and the shadow it casts at a certain time of day. You can tell how much oil is in that country at any point in time. There's like parking lots now. You can analyze how much, how many customers Walmart gets or a hospital gets, and you can determine how many people have the flu based on, who's in the hospital and stuff like that too. It's crazy how detailed you can get. But the problem is, well, how many traders are actually buying this data and actually taking advantage of it? To be honest, it's not as much as you would expect. There's a lot more service providers, a lot more data out there, but unfortunately, that 90% of data that started to exist in the last 2-3 years, not a lot of it has been fully taken advantage of yet. We just have yet to discover ways to really take advantage of it in the asset management industry, I believe.
Yeah, I remember back in the day, a few years ago, when Netflix had a competition to see who could code the best recommendation engine. I remember people thought that was really cool and innovative at the time. And now we just take for granted, obviously, these things recommend films and series for you. But Pavan, can you tell us a little bit about the use cases in banking? Is machine learning the dominant technique, and what do you use it for?
So, it really depends on which area of banking you're looking at. There are certain areas which have caught on more, with these techniques than other areas. To give you an example, the retail banks have generally caught on much more aggressively on ML techniques for a variety of reasons, which I'll go into in a second, as opposed to some of the other, asset and wealth management hasn't really caught on as much. The, CTC function hasn't quite caught on as much. And part of the reason is that, the retail bank has a very specific set of issues that they deal with, and one of the key issues is fraud. And where fraud is concerned, machine learning is a very appropriate technique to determine whether a given transaction is fraudulent or not. One, because ML techniques are in general quite black boxy, and they are highly nonlinear techniques. They are very complex techniques which don't have really a lot of intuition behind them. Now, when you're looking at a transaction and trying to determine whether it's a fraud or not, and you have to do it in a split second, you can't have a person sitting there or even a statistical algorithm, because these fraud techniques change very, very quickly. The fraudsters actually, I'm being told by some of my colleagues in the industry that the fraudsters actually have better ML techniques than we do. And I'm not kidding about this.
Yeah.
So we have to keep up with that. And in a situation where you're trying to determine fraud, you don't really care about intuition. You only care about whether a given transaction based on a bunch of metrics that you're trying to pull in is actually fraudulent or not. And that's why it's caught on much more with the retail bank. And then the second area that I think is is quite interesting is the investment banking side, order routing, for example. And then there are, a variety of techniques which are pretty much common to, across a lot of these lines of businesses, such as NLP or natural language processing, for example. Having some kind of an assistant that can help answer questions using ML and AI techniques. So those are kind of, broadly dispersed across the industry.
Okay. But Gautam, I mean, you work with a wide variety of clients on a lot of practical use cases. Can you take us through some of them? I assume fraud is one of the ones that you also work on, right?
Yeah, so a lot of what Pawan said in fraud and traditionally these techniques have been applied to what's known as the middle and back office areas where there's a lot of this crunching that has to happen and people looking at stuff. I think some of what we're seeing is that migration of more towards the front office, and that includes contact with customers, right? So the continued use of chatbots, again, not very new. Most of us have been going to websites and have that little box that pops up and says, "Can I help you?" Right? And some of us have probably even used it. And initially, that might actually be a real person behind that box talking to you, but what's happened is these techniques are allowing for some of those interactions to be automated, right? So an example of this is the escrow process in the US. Most of us have escrows on our mortgages, which include payments for taxes and insurance. When your taxes and insurance goes up, then you have to have a settlement process with your bank that decides what's going to happen next year to either increase your payment or you pay something up front and keep the payment the same, or you do something in between. That's been a huge area of problems for banks, and you'll see in the call centers, volumes start to rise up as those escrow settlements happen because people call and complain all the time that I can't believe you raised my payment, you didn't tell me, even though they got all the mailers and they got all those things. So the creation of a chatbot that would actually proactively reach out automatically without a person at the back end saying, your escrow settlement requires a change, and to taking the customer through the entire process all the way to making the decision on do you want to have a higher payment, do you want something in between, or do you want to keep the same payment, and that means you have to fund the payment. All the way through that, there are techniques like this now that can be applied to facilitate that end-to-end process. And we'll see a lot more of that happening to cut off so there's two things that are critical there. The interaction that happens when a customer calls in with that complaint is probably the most expensive interaction for the bank, where you have to have a person get involved now, research it, try to fix it, try to undo it. Sometimes they have to go all the way to the back office and say, no, the customer really wanted to do this. Those tend to be very expensive interactions. So the fact that you can prevent them before they happen is number one. And then number two is obviously the standard customer satisfaction, right? You want to use those experiences to generate more confidence in upselling, cross-selling. It's a competitive world. All the banks are kind of somewhat stabilized in their top-line growth, and this is a way to continue to enhance that. And I think we'll see a lot more move towards that stage of using all of the techniques and the data, right, to the point Christina made, that every 5 years, the amount of information we have literally doubles. This is from the beginning of time till then, right? So using that data effectively to help the clients, I think, will be a big trend.
Yeah, I kind of assume half of that is baby photos on Facebook, though. I mean, one of my favorite stats is, if you take all the data that is going to be produced within a couple of years and put it in iPad ears, you can stack them on top of each other all the way from Earth to the moon 5 times, which I thought was, like, for journalists, we kind of like to see things in physical.
It's a good visual.
But so broadly speaking, we're talking about the initial usages so far have been mostly back office, but you're starting to see it spread and migrate into the front office as well.
Definitely in the financial services space, more of that front office interaction is going to be led by these techniques.
Okay. There are some convenience applications. For example, I'm sure you've read in the popular press how JP Morgan is now using Alexa to send research articles to clients. So clients can actually ask Alexa to send them a certain research article. Mm-hmm. So that's a convenience thing, right? You don't have to go on your iPad or your computer to download the article. Or, you could see situations where, a client calls in, he's having a discussion with a salesperson or a trader about certain trades, about certain markets, and, you could have an engine working in the background trying to figure out exactly what kind of trades this person is interested in. And then, linking that up with the research that JP Morgan produces and trying to see, where there would be a fit, and then have the salesperson make a recommendation based on what kind of questions the client is asking and what kind of research we are publishing.
Along the lines of that, actually, what I think surprises a lot of people these days is actually, people who use these machine learning and AI techniques. It's not just the quants and the high frequency traders. People, even the most discretionary, I was on a discretionary desk a while back, and even the most discretionary traders these days, not all of them, but there are some discretionary traders that are using these types of tools to do, they're not going to be coding it or, doing that kind of stuff anytime soon, but what they might do is, if it's really clean and they can just talk to it and be like, hey, what are the recommendations for the day, they can generate recommendations based on certain, inputs that they have and still come up with something to make, make their analysis more thorough. So we see that even on the discretionary side, which I think surprises people because it seems like just a quant thing or a little niche thing. So that's always surprises. Also, the misconception that I also wanted to bring up, since you guys mentioned the front office, is that a lot of people assume that high frequency trading, is the same as AI, or that we all use AI techniques to trade. And actually, in our industry, that's not the case at all, almost. So I'll give you an example. Like what's useful in terms of ML and AI techniques is if you look for ideas, right? So I mentioned like textual news feeds. If you're going to look for ideas to trade, that's one thing, and that's very useful, obviously, because you have a lot of unstructured data to look at, and you want to find the opportunities. But then there's a separate thing, which is executing the trade itself, which is a completely separate thing. Once you have the idea, how do you actually make that into a trade? How do you implement it into your system? And you had actually mentioned how AI is actually really slow. It's complicated, it's complex, and because of the complexity, the nature of it, that means mathematically it's actually very slow. The computing power just takes up a lot more load, and because of that, we are doing fast trading here, and this is the complete opposite of our thesis, right? And so the actual execution and implementation of what we're doing are just simple callback functions that are, you wouldn't believe how simple the math was in the trading that we're doing. We might be trading, $1 billion a day or whatever, but it's actually really simple, even though it's done by a computer. And, the artificial intelligence and machine learning stuff, we keep that to, the maybe higher up in the pipeline or a little bit lower down after trades, post-trade analysis and things like that. But definitely not in the actual execution itself.
Yeah. Well, I think it's interesting that point that on the discretionary side that this isn't something that's just in your world, but it seems to be kind of infecting, invading everything. I think it wasn't that many years ago that if you asked most people, traders on a bank or buy-side desk, what Python was, they'd say it was a snake. But that is no longer the case. But I still kind of feel that outside of certain niches and certain people or firms that have been very much on the bleeding edge, finance has been pretty slow and conservative. I mean, is that fair, or am I just being mean here? I mean, I was thinking, you didn't mention these chatbots. I don't know how many people saw that video, the Google Assistant calling up to order lunch. And, it blew my mind. But, in a few years' time, we're going to think that's old. But finance, I keep hearing people basically brag about stuff that kind of feels, a bit meh, really.
No, that's absolutely right, I think. And part of the reason is that finance is a heavily regulated industry. And so anything that they do is heavily scrutinized. You can't really make any missteps. Models have to go through a very, very complex and a long drawn-out, model review process before they can be put into production. And it's not like you can just go out and put a model into production and start trading on it, because if it makes a mistake, you're going to be liable for any losses that it incurs against your client. And that's part of the reason why banks have been kind of slow on some of these more advanced kind of technologies. Now, where it doesn't make a difference, or doesn't make as much of a difference, like fraud detection or AML detection, even there you'll see that, for example, for AML or anti-money laundering, you'll notice that even if a bank puts in a machine learning algorithm to try to figure out exactly which one of these transactions are AML compliant or not, they will generally have a human being just double check those numbers. And that's just to make sure that they are not running afoul of the law. Now, of course, 2 years or 3 years from now, as people become more comfortable with these methodologies, things might change. They probably will change, where you will cut out the human being from the process, and 80% of the trades or transactions that you were looking at initially are gone from the system, because your machine learning algorithm is so good that it's pretty much figured out that those are not, or those are AML compliant, effectively. And that is what will reduce the demand for labor in these kind of transactions.
Yeah, I'm going to get to the labor reduction demand.
I think the other factor that's playing a role in your comment about the adoption being a little slow is that most of us know in the financial services space that a lot of the technology is quite old. Some of these legacy systems are literally 25, 30 years old. They're still mainframe applications. And layering these technologies on top of those things is not very easy. And so there's probably a push and pull on where to truly invest from a transformation standpoint to continue to try to put these layers of technology and or Band-Aids on top of these existing systems, and at what point do you start actually changing those systems and migrating those to new technologies as well. And that's part of, I think, what the industry's been trying to figure out. And there's work going on in all areas trying to figure out where they're going to balance that and how they're going to get to their end state.
The other thing is also, if you, I'm trying to think of how to put this, like there's a reason why, companies like Kensho Finance and I don't know, there's a bunch of, new kind of, what do you call it, fintech companies that are coming up, right? And they're startups. There's a reason why they're startups and why they didn't start out at Goldman Sachs, why Goldman Sachs didn't do it. They ended up acquiring Kensho, right? It's because at Goldman, I'm sure, I used to work there, so I can say, there's definitely a lot more, at a big company in general, there's more red tape. There's people who found these young fintech companies, they're young as well, and younger on average. I shouldn't say they're all young, but if you go to, for instance, there's a huge crypto conference, down the street right now that's happening. It's one of the biggest ones apparently, and you look at who's speaking and who's there, right? The average age there, it's like they're like my age or younger even, which scares me. But that's the, and I can't see them going to a company like a Goldman Sachs, for instance, or a JP Morgan, and creating the things that they've created, and I think so a lot of it is just the innovation is happening at a slower pace because, finance has been around for so many years, so many centuries, and it's, there's this one status quo way of doing things, and this new technology and these computers, it's like no one knows what's happening, blockchain, crypto, like who knows, right? You never know what's going to happen. So that's definitely one thing. And then it was funny because I was at a conference, in Florida with the Atlanta Fed actually last weekend, and the whole topic of the conference, this is like regulators, this is a regulators conference, right? And it was on AI. It's pretty much the same topic as here. But then 2 weeks ago, I was at a conference in New York City again. No, sorry, yeah, here, and it was like the biggest hedge fund conference that they have in our industry. And I gave a talk on high frequency trading, and afterwards I realized after giving my talk that I was the most normal. We were the most normal hedge fund out of the entire group of hedge funds that presented. Everybody else was blockchain and crypto and Bitcoin, and esoteric, strategies that are not on the, products that don't even exist on the market. We were the most vanilla, least, I would say least, what do you call it? Just the most normal company out there, and that's shocking because when we started our company, 6 years ago, we were considered. No one even knew what high frequency trading was unless you worked in the quant industry. And then after Flash Boys came out, we were the controversial thing, and now we're considered just kind of normal. And blockchain's the new hot thing down the street, right? And so it just shows you how fast things are changing today. It's crazy.
Yeah. But especially in the finance industry, I take your point that actually quite a lot of people, if you don't want to work at JP Morgan, Goldman Sachs, or even maybe with Two Sigma or per se Renaissance. But to what extent is just human talent a bottleneck here? Because it's not just competition from the hottest new blockchain application, but it's Google and Facebook and the entire Silicon Valley and around the world. Also normal companies, industrial companies, our airlines are using more data. Oil companies, one of my colleagues wrote a great piece about how oil companies are getting better at eking out more reserves out of the wells because of better use of big data through AI. I don't know if, I'm not going to mention his name, but there was my favorite example of this was a young data scientist at one of the quant funds who had a great reputation, but he got poached by a big sort of old school discretionary fund.
I know who you're talking about.
26 years old and made $3 million guaranteed starting salary. For me, that really summed up just how hot data scientists are these days.
It's incredible, right?
Yeah.
I know who you're talking about too.
Yeah, but how much do you guys? Do you have a problem finding people to do the stuff that you do? That you kind of know what the plan is and what you want to do and all the cool stuff you could do. You just can't find the people to implement it.
So just really quick answer before I let you guys. So I'm sorry for taking up so much time, but today when you. A lot of you guys probably have kids who are growing up or in college. If you want to enter finance today, don't study finance, right? You study math, or computer science, statistics, some kind of applied math or computer science, right? Because that is what's going to guarantee you a long, fruitful career in not just finance, but also in tech and, other industry, anything
almost,
really
yeah.
these days, right? And that, unfortunately, that also shows that our current finance curriculum, what I learned in the classroom, when I was in college not too long ago, I don't use any of it, on my job. And I think that's a shame. I think that we should be learning more applications of finance in our industry that we're currently doing right now. So I think that needs to definitely change. I know there's some master's programs out there, masters in finance and like quant masters, whatever, math finance programs out there. And those are great, but I think it should also start at the undergrad level as well.
No, completely agree with that. I would say, if you look at banking back in the 90s and the early 2000s, obviously the industry was growing rapidly because of the advent of, derivatives. And, back in the 80s and 90s, people were still trying to get their arms around, how to value these derivatives, or especially the exotic ones. And so there was a real need for people, who could do that. Now these techniques and, methodologies are fairly standard around the industry, and so it's fairly easy to say, where a swap should be valued or where any kind of an exotic option should be valued. The bigger issue is around, as you said, Christina, is around, technology and what you can do with it, and that's where the growth area is.
Personally, for me, I think what you said is valid, and it's always a challenge because there's more options for the younger generations. We've taken it to make sure that not only do we invest in that, but also that we invest in existing people that have the capacity and want to learn about new stuff. Yeah. So that's something we invested in pretty heavily, and we actually have a digital fitness app where people go and kind of score themselves, and then it recommends things to get better educated and move up the digital fitness scale, right? And along with that, we have tours of duty through AI and machine learning projects that are going on. And so I think, for me, I've been surprised at the amount of core resources we have in-house that do have the aptitude, want to learn, and are willing to actually set their foot in, but just never had that background, didn't even know how to do it. And that's been a good gold mine for us to tap into to leverage.
I think we have to all learn, to be honest. Like here, even though I'm in this industry, I'm still constantly learning about like different techniques and, how different companies are using data science and artificial intelligence. I think it's something that we all have to do to evolve as an industry, and if humans have always evolved, if we didn't, we'd all be farmers today. So, it's just a continuous evolvement. The other funny thing I just want to mention really fast is if you look at like Goldman Sachs' website, I think over half their jobs that are available for their job postings require some kind of quant, computer science or quant or math kind of skills, right? That's a huge change from even, 5 years ago or 10 years ago. And so we're in a different era today than we used to. I think they try to call themselves a tech company.
Yeah, that's a hot thing. Every asset manager and bank I talked to somebody at Goldman tried to, what was it? How Prince was the artist formerly known as Prince. Goldman Sachs was the investment bank formerly known as Goldman Sachs, but now it's a tech company. And I remember like Two Sigma's website, I saw the recruitment video. Two Sigma's a big tech, quant hedge fund, and I did the recruitment video. It's like a 3D video, and they brag about how few people with a finance background work there. And basically, their technology companies happens to manage $50 billion. It's
no big deal.
Just something on the side. Most of the time, we'll just play around in our robotics lab, and then manage 50 billion on the side. But obviously, the AI and big data, these aren't silver bullets. I'd love to hear you guys explore a little bit about the potential pitfalls, the dangers, what we get wrong. One thing I do love when I talk to, frankly, one thing that I love when I talk to quants about this is that I feel quants are frankly far more open and gleefully willing to embrace some high-profile screw-up they've made than any discretionary trader or banker. Now, everybody's got some terrible backtest that they thought made them look like a genius, and then it crumbled in real life, as it were. So have at it. Tell us about how can it go wrong? How does AI go bad?
Yeah, obviously we've heard some of the anecdotes of you can teach a robot to do bad things, right? So including some of the Microsoft one that happened a few months back. So
was this the chatbot that turned into a Nazi or something?
That's right. Yeah, that's right. So
I think that says more about us humans, frankly. It learned from our behavior than the robots.
That's right. So there's a lot that can go wrong with these, and I think from my experience and keeping it just to financial services and the space we're talking about, I think it's important to have a vision of what the longer term goal is and what that transformation means to the organization, and then matching that to what's possible with the organization and its capabilities, and trying to move to transform end to end as opposed to trying to do these point things. And that, to me, is a big pitfall a lot of times that I see organizations go out with. It'll be very specific and say, we're going to save X amount of dollars in this particular space, and it's largely driven by cost reduction initiatives. But then when you get to start applying it, forgetting all the malicious stuff that can happen, it gets really hard when you try to say, across a team of 50 people, I saved 20 minutes here and 30 minutes here, and so yes, I can say I took out 2 hours of a person's day. Now, how do I truly monetize that, and how do I take these bits and pieces across 50 people and generate something that can either be a new capacity for me that's going to help me generate top line revenue or help me reduce cost? And not thinking to that properly is the biggest pitfall I've seen, because they just go ahead and start projects and start to capture that, oh great, I saved 15 minutes here, without thinking through how that would happen. And the reason why that's hard is because change is hard. And so you have to truly think about the human element in all of this, and think about what that means when you do have those buckets of savings, and how you're going to either, probably some subset of people will have to be reskilled, some people will have to be upskilled so that they can do more of the work that you want them to do. And then there is going to be some subset that's already happening with attrition and stuff that you have to just balance out and say, how can I balance this against attrition so to where I don't have to worry about some PR mess that says I laid off a bunch of people, right? I think if you think about it that way and manage it, that's one of the pitfalls that has been the hardest for people to get around.
Yeah, and I would say that, if you look at if you want to figure out, where a machine learning model can go wrong, you have to really look at the risks in these models. What is it that we are missing in ML models relative to, let's say, a typical statistical model or a human being? And that kind of goes back to the earlier comment I was making around, how these models are quite black boxy and without much intuition. And the reason is that these are extremely complex and extremely high order, effectively high order functional forms that they're fitting to, let's say, predict a certain variable. Let's say I want to predict whether a transaction is fraudulent or not. I'm going to look at, say, 600 pieces of data. I'm just pulling out a number here. 600 pieces of data, and I'm going to try and fit this response variable to these 600 pieces of data in a certain very complex functional form that people really don't have much intuition around, or can't even really figure out at the end of the day. And then I'm going to predict that response variable. Now, the problem is when you don't have any intuition around what's going on in this black box, if something does start to go wrong, you have no idea what's going wrong. If you're trying to predict, let's say, unemployment with GDP growth, well, you know what Okun's law states. You have a rough idea about, how the economy should work. There is a theory behind it. And so if it doesn't work, you at least know, you have a rough idea about why it's not working. Here you have no idea at all. Now, what that basically means is that there are, several risk mitigating measures that you would have to take, especially in a situation like the financial services industry, where, as I said before, you're heavily regulated, and the risk of something blowing up is reputationally very large. And one of the ways that we try to mitigate this risk is by actually running a statistical model concurrently with the machine learning model, at least for the next couple of years, to make sure that if there is a problem with the machine learning model, I want to know whether there's a concurrent problem with the statistical model, which is intuitive and where I can touch and feel and figure out exactly what's going on, and then look at the divergence between the two. So, for example, I could have a situation where the machine learning model goes from a 55% hit rate to, let's say, a 60% hit rate, which is an improvement, obviously. But then the statistical model might go from a 50% hit rate to a 75% hit rate. Now that's an underperformance of the machine learning model relative to the statistical model, even though in absolute terms the machine learning model is doing reasonably well. It's gone from 55% to 60%. But my statistical model has gone from whatever numbers I quoted, 50 to 75. And so now you need to start worrying.
So let's take a step back here, right? And let's take it at a very high level. We tend to compare machines to perfection when we should be comparing the effectiveness of machines to humans, right? So if you look at Uber's autonomous self-driving cars, there was one accident, and because of that accident, unfortunately, the media hype, Uber had to cancel, and Toyota, a bunch of companies, canceled their self-driving innovations and programs. They took all the cars off the road because of one accident. But if you got to compare that one accident to the 45,000 accidents that humans make all the time, you know, and so yeah, mistakes are going to happen with machines. So let's go back into our industry now in the hedge fund space. When you think about quants and crises, you tend to think about flash crashes, right? You probably heard about the 2010, you know, giant flash crash and
It's all Christina's fault, really.
all those. Yeah, it's all my fault. Just kidding. So just to give you some examples here, when we look at the I think it was 1980. Oh my gosh, I should know my history. 1987, thank you, Black Monday, is that what it's called? The Black Monday crash in 1987, right? And you look at the impact of that. How long did it take to recover? Some, like scholars that we talked to, they argue it took 10 years for the markets to recover from that crash. Whereas today, you know, after 2010, you look at all the little flash crashes that have happened since 2010. I mean, they're not little, but they're, you know, pretty significant. It took 10 seconds to recover. 10 seconds versus 10 years, you know, and a lot of that is due to the abundance of, you know, faster traders and the abundance of people who are able to make quicker analyses and to correct things when they notice something that was incorrect. Okay, let's correct it back up to the place that it should be. And so I think that is also, you know, that's also one of the examples where we have seen some improvement, I think, in terms of, yeah, the risks are going to be there, but we, you know better than anyone else in terms of how to actually mitigate those risks and how to address these issues when they come up.
Yeah. Well, I mean, on the Tesla, I mean, there are obviously fewer self-driving cars than there are, so it's not a fair comparison. But, you know, there's a term algorithm aversion. There's some professors that actually quantified it, that they did an experiment with humans and predicting the weather. When humans obviously screwed up all the time, people still basically had this vestigial trust in the humans, at least were trying to do a good job. They trusted the machine more until the machine made one mistake and they lost all faith in the machine. Even though the machine was still radically more accurate than the human, they still lost all faith in the machine. But that does seem to be changing, though. I mean, for example, I always think of, you know, the way, you know, it wasn't that long ago that the idea of going into elevator without somebody hitting the button for you was considered dangerous. And oh my God, how can we ever do that? Now, basically, planes fly themselves. Cars will, you know, inevitably soon.
Yeah.
But are those flash crashes something we can that glibly dismiss? I mean, I take your point that obviously we haven't had an 87, but there are exchange-level safeguards have been put in place for that.
Yeah.
But, you know, when you have, you know, multi-trillion-dollar losses that for 10 seconds, that's still kind of scary.
It's scary.
And given how complex and interconnected global markets are we adding, you know, I always think of markets as the most complex system of the entire world because it connects 6 billion people in this incredibly complex system. And complex systems we know have a nasty way of at some point having some sort of catastrophic breakdown with the right confluence of events. I'd like to hear, I mean, do you think
that might happen with crypto?
Yeah.
You know, with Bitcoin or whatever.
Cleaners,
right? If someone sells all the Bitcoin, it could go to zero the next day if certain people out there, you know. But I was going to say, actually, so there these days, like, there's a lot better ways to, because a lot of times when you think of the black box, you think it's just like this mysterious thing of code where, you know, we don't take responsibility for any of our actions, right? But it's actually complete opposite. You know, and I was advocating this last week with the, you know, with the Fed, saying how, you know, with GitHub and with all these central repository systems you guys may or may not have heard of, you know, actually we know exactly who's responsible for what piece of code. And, you know, these companies that do, if they do spoofing or spamming or any kind of market manipulation, you know, they get fined. And it's a huge deal out there. I mean, I'm subscribed to that, you know, those email lists with the, what is it, the NFA and the SEC and stuff, and they'll email us every day being like, you know, these people got fined and they're banned from the NFA and stuff like that. It's pretty harsh, actually. And so for us, it's the same thing. Like, you can tell, you know, even though it's just one trading system, I can tell exactly who was responsible for which piece of code. I know, you know, who committed what code. I know who's responsible for what. I know in terms of which trading strategies, you know, who did what because of GitHub and because of the technologies that are out there that allow us to, you know, have the central repo. One of the other advantages, just as a side note, is also, you know, we can have people who work from different countries as well because of it now. You can be pretty much anywhere in the world and contribute to strategies, which I'm sure you've know a lot about too.
Although
So
I must point
yeah.
out that, a flash crash does not necessarily imply that, machine learning or artificial intelligence algorithms are at stake here.
No.
Because, if you look at the flash crash of, I think, 2011, was it? Clearly we didn't have ML AI techniques back then, and still we had flash crashes. Now the question is, how many ML AI algorithms do we have which are actually leading to these flash crashes? My suspicion is it's not a lot. I mean, I could be completely wrong, but
I think the argument I'm trying to make is that Mark's already complex and are prone to crashes because humans, frankly, are just as dumb or dumber than any machine. But we are layering on or injecting into an already infinitely complex system more complexity and more things that we don't fully grasp. I'm not talking about, oh my God, we don't understand the Skynet. Just complexity. That the way that various trading algorithms might interact with each other out in the wild in unforeseen ways. And that is something that, we'll have crashes and we'll recover for them. There'll be a nasty period in between, as it were. But you think I'm being too alarmist journalist there?
If you look at the, recently there was a Fat Fingers event, right, where somebody sold a bunch of, I believe it was the
Was this in Korea?
No, this was here.
Okay.
This was about maybe a year back or so, where somebody sold a bunch of futures. I think they were rate futures, and causing the market to dip, temporarily because he sold 38 billion instead of 38 million, something like that.
I mean, who among us has not done that before, right?
And so the point I'm making is that it's not we can't really start to blame ML AI techniques on things like this when my bet is that most companies at this point are still using regular algorithms as opposed to ML AI techniques to trade.
They're messing up in old school ways.
In old school ways, exactly.
Yeah, and I think part of the structure and the way it's set up and probably worked to the advantage was a lot of these bots, so to speak, are treated as people. So a lot of banks actually onboard these bots like they do people, and these bots have user IDs and passwords that are fully like people. They have audit trails. They go through the same QC mechanisms in the process workflows. So in the longer run, that might not be the fastest way to take advantage of these, but those checks and balances are built in, partially because it's regulated and they want to make sure that they're covered, but partially also because these things are new and it's better to put more checks in place than to have less. And so I think they've erred on the side of caution to make sure that at least there's the same level of protection as there was before.
Yeah. No, I have to admit, I mean, most of the quant firms, like Domeyard, people do take these kind of things quite seriously. And
You kind of have to, right? I mean, every time I go to one of these, especially 3 or 4 years ago when Flash Boys first came out, go to any of these conferences and I'm sitting here and someone raises their hand and they're like, I hate everything you do. You guys are a fraud. You're money laundering, whatever else. And we have to explain to them all the misconceptions that, that the book had. And there's, it does make a good point, but also there are some things that were wrong. And so, we had to early on, even as a small company of back then we were 5 people, we had to still defend not only ourselves, but also understand how the industry works as a whole and be able to kind of speak for the industry at some of these occasions.
Yeah. No, I remember that book. I mean, I spoke to Ari Rubinstein at GTS, which is another big high-frequency trader about this. He went on the record about it, but he's a huge Michael Lewis fan. And when he heard Michael Lewis was going to write a book about high-frequency trading, he was so excited. My God, this is going to be a story about how these nerdy tech upstarts took on the big banks, beat them, and drove down costs for the small guys. It's going to be a money ball for the finance industry. And then the book pitted him and basically the high-frequency trading was the bad guys. Yeah. And he's just devastated. But, it just goes to show that it's so tempting to always blame the machines, right? Mm-hmm. I do want to turn, and we have a bit more time, and we are going to let you guys all ask questions as well. We have a solid chunk of time for that. Job losses. I mean, I know we've talked a little bit about it already, and I think obviously we all know that it's more nuanced than just kind of job losses. But, on a personal level, I saw Bloomberg's editor-in-chief recently said that a quarter of all their stories have an element of automation in them. And for me, I've always thought of that as, that's great because I do all sorts of boring things that, frankly, I think an algorithm can and should do anyway. And nobody can write a bad joke as well as I can. No algorithm can beat me at that. But you know, a lot of the things I did in the first 3 years of my career was the kind of stuff that you'd automate. So I do worry about that side. So it's sort of cognitive skills, but low-level cognitive skills. I mean, what kind of things can you see? I mean, you've worked on the sales side as well.
Yeah.
What kind of jobs are going to be the ones that go the way of the dodo?
So I've worked, let's see, when I was at Goldman, the team that I worked on no longer exists today. And this was like maybe 7-8 years ago. When I was at UBS in Tokyo, actually, that team no longer exists either. And they were all replaced by, you know, trader, I don't know what you call algorithms and quants as well. And so I think the key here is just quantitative knowledge. Those teams didn't have that quantitative knowledge, and so those jobs are quickly automated away. You know, my job on that team in Japan was just, you know, we would take in research that the researchers would put, and we would literally just input trades throughout the day. And you know, that seems pretty simple. It's like, actually, yeah, you could have a machine do it more accurately, you know, without the fat finger problem, and actually do a better job than me. You know, whereas for me, if I'm guessing what's going to happen in the marketplace, I might be emotional. I might make a mistake, or you know, make some kind of mistake that a machine wouldn't do. And so I think definitely that is what we've seen. And we've seen, if you look at hedge funds, like our industry now, if someone's starting a hedge fund today, I assume it's crypto. If it's not crypto, it's going to be some kind of quant. If it's not quant, I'm like, what are you doing? Unless you've had 40 years of experience in this industry, yeah, sure, you can start a, you know, long-only fund and do decently well. But, you know, if you're like 20 years old and you're starting a long-only fund, I do question, like, where is your experience in terms of getting that kind of knowledge? Because as a millennial, our edge is on the quant side primarily.
I'm quite bearish on the job losses. I'll give you 3 examples here. So the first example is around treasury traders. So about 15 years back, we had about 17 treasury traders, and today we have maybe 6 or 7, you know, who are doing twice as much volume, and you know, the size of the market has grown by a factor of whatever 3 or 4. That's the first example that I would give you. The second example I would give you is 30 years back. If you look at J.P. Morgan's investment bank, and you look at the revenue per person that we generated, today the revenue that we generate per person is 30 times as much, even though we have only 3 times as many people. So the productivity is roughly 10 times over a period of 30 years, right? And the third example that I'd give you is around horses. So this is something I read in The Economist, you know, about a year back or so, which was looking at, you know, how many horses existed at the turn of the century before, you know, the motor car came into existence. And their conclusion was that we went from roughly 17 million horses in the United States to roughly 2 million over a space of whatever, 2 or 3 decades. It kind of shows you how when a resource is no longer needed, nobody uses it. I mean, that's not saying something very profound, but it basically, you know, tells you exactly how these job losses are expected to happen, because, and we've already seen that in the industry, right? If you look at the banking industry, it's shrunk a reasonable amount over the last, you know, decade or so. The top 5 or 6 banks in the United States alone have shed roughly 150,000 jobs, you know, partly because of automation, not all of it because of MLAI, obviously, but MLAI will only hasten the process and will make it much, much more efficient for one person to answer, you know, a number of queries as opposed to answering a certain, you know, small subset of them. I'm talking about like a regular customer service person, let's say. And so I'm quite bearish. I think, you know, machine learning and artificial intelligence, at least the way I'm seeing it going, will definitely result in a reasonable number of job losses going forward.
Are you worried about that?
I would echo that, but I think the creation of new jobs that will come as a result of other ancillary things that will come out of this, and some of these we don't know, but we can look to previous advancements in technologies to try to benchmark it, right? So if you look at what's happened to the ad agency world and marketing automation in general, it's drastically different now that you or I with no tech skills, I don't know about your tech skills, but me with very little tech skills can go design a website, start up a company, get a full business up and running, integrate social media, do all the marketing that I need to without the help of an ad agency, right? And a lot of companies went through that transformation, and a very small portion of their budgets now go to true ad agency marketing versus all these other marketing things that they do. That generated lots of opportunities for new types of skills and new jobs that came as a result of that. So I think in the short run, there'll be job losses, but it'll create opportunities for those that want it in ancillary areas that will mimic some of the things we've seen that have happened in the past.
One example of the created jobs is data scientist, actually. Like we actually analyzed job applications over the past, 6 years or so, and you look at the keywords in their resumes, and data science is one of the ones that just skyrocketed over the past 6 years, because back then no one knew what it was, there were no data scientists, and now, people are starting to have, their previous job was data scientist at a certain company. Those are all relatively new positions now, and in terms of job loss, there's a job loss in terms of if you study traditional finance in college, it'll be harder for you to get a job, as a trader, for instance, a discretionary trader. But at the same time, if you study computer science, there's a huge opportunity out there, because all these companies they're paying, the salaries are insane, in our space for these types of roles. So there is
insane salary, guys.
There's a demand for, you're talking about 3 million base,
Yeah.
for a 20-something-year-old kid, right? And some of these companies in New York City, our competitors here, it's so hard for us to hire, because one, we're in Boston, and two, because their salaries are so high. We'll ask them, what are your expectations for salary? And they're like, oh yeah, I make $1 million a year base, and then my bonus is about 6-7 million, and I'm like, oh God, and this is like a 22-year-old person. And so there is a lot of demand still, and not a lot of, people go to Silicon Valley, and not a lot, come out here, so we need more of that.
Apparently biologists. There's lots of molecular biologists that's been where people home because they're used to big data sets. No, nothing about finance. But apparently, the biggest growing course in the US now is something and data science. So economics and data science, business management and data science, mathematics and data science.
Yeah, and it's mainstream when you see it in the subway, right?
Yeah.
Career in data science.
Yeah, exactly. Yeah. I do wonder how many of those people just basically taught some Excel skills, but so I think we'll run out of time for the main chat, but I hope we have lots of really good questions, hopefully better than the ones I got to ask. We have a couple of microphones. When you stand up, can you please just say who you are and where you're from, and as in where you work and things like that. We have a gentleman at the back there with his hand up. I'll try and get to all of you, but have patience if I don't see you immediately.
Thank you. My name is Katsuo Takeda. I'm working for Morgan Stanley as a financial advisor. Thank you. By the way, thank you for this very mind-stimulating topic and your lecture. I will try to ask you a question. This topic is beyond my intelligence, so that I try to create some question to you. So I'm quite an old guy. I'm exposed to IT and then AI last 10 years. Today I have an iPhone and I try to send a text. When I hit TH, the iPhone already suggests, thank you. Next one, for your mail, without thinking myself. So that AI is friendly to me, so as I'm becoming friendly to AI at the same time. And then today, the 3-year-old baby, they started their education with AI and the IT, like or dislike, which is totally different from when I was a kid. So that is one thing. The second thing is AI enhanced efficiency. That if efficiency increase, maybe I'm wrong, but if efficiency goes ultimately reach to the point, and then we're gonna have only one answer. And then my question to you is, when today's 3-year-old baby becomes 23, 20 years from today, and then can we afford to have a different answer, or are we gonna have only one answer? And then what kind of market we're gonna have after 20 years?
I'll take a shot. I'm not a philosopher by any means, but that's a good question. I think that finance is not a winner-take-all industry. So there's not one answer, actually, in finance. If you think about it, in social media is a winner-take-all industry, right? In America, there's Facebook, and in Japan, there's Line, in China, there's, WeChat. Like, every country kind of has its dominant player. But look in finance, right? Like, there's there's JP Morgan, Morgan Stanley, Bank of America, Goldman Sachs. It's designed to these companies are designed to coexist. And there's a bunch of smaller, players out there like us that, can still make a living and coexist with the larger players out there too. So there is no single answer. There's no single firm or no single idea that's better than all the other ideas. In this market, it's designed by nature. You need to have different ideas in order to survive. You need to have different views in order to go forward in this space.
Yeah, and the world is changing, right? So 20 years ago, we wouldn't have thought of climate futures and some of this, all the stuff that climate change has brought along where people are actually trading on that. So like we talked about, the rate of information doubles every 5 years. In 20 years, there'll be other problems that one answer can't always solve the same problem. So I think that information will bring new opportunities and new problems to solve for that 3-year-old will have to deal with when they're 23, right?
No, absolutely. I completely agree with that. I would just say that going back to the earlier comments that we were all making around job losses versus job creation. The issue that I see is that the job losses will happen at the lower rungs, of the people that are perhaps not as highly educated or perhaps are doing repetitive tasks which are very easily automatable. And the job creation will happen at the upper end of the education spectrum. And so it's going to disproportionately impact society. And number two, I think the number of job gains that will come eventually from new technologies will be much smaller than the number of job losses that happen because of this automation of repetitive tasks. But that's what I wanted to say.
Yeah. The lady here in the blue jumper and glasses in the middle, please. Can we get her a microphone? You can try and stand and shout it out, but the microphone might be easier.
Hi, I'm Lydia. I'm an intern at UN Office for the Coordination of Humanitarian Affairs. I just started there, and I had a question that affects many other sectors besides just the financial sector. But I was wondering how you guys would deal with this issue of, so there's a trade-off between the information that you gather and how much information that you have, and then along with that same side with getting too much information or what people would perceive as too much information and find it like a threat to their privacy, or even just that the information that they put out there is being used in a way that they did not consent to. And then on the other side of this trade-off is not being able to develop a tool that is efficient and effective enough to accomplish a goal to be able to compete with your competitors. So I was just wondering, how do you guys deal with like this trade-off, and is there any like regulation that you always keep in mind to help you guide your decision?
So let me try to answer the first part, which is the privacy part. I think the concept of privacy is very, very different from one country to the next. And even within a country, between one person and the second person, it's extremely different. So honestly, if somebody were tracking me 24/7, I couldn't care less. But I'm sure that most people in this room would care about it. And just to give you an example, there was a Wall Street Journal article about 6 months back that talked about China and how far advanced they are where MLAI is concerned. So they were talking about this lady that frequently jumped red lights when she was on a bicycle. And apparently they have a system where they can actually track your face and figure out exactly who you are if you're jumping a red light. And so the third time that she did that within a period of couple of weeks, there are these massive TV screens that capture you above an intersection. And this TV screen, her photo came up on the TV screen as she was jumping the red light and said, whatever her name was, this is the third time you've jumped a red light in 2 weeks. And she says that she was so, embarrassed about it, she never jumped a red light ever again. So that's the kind of, that's one end of the privacy spectrum. And then the other end could be whatever, one of the developed markets where, privacy is obviously very valued. So it really depends on, how you think about privacy as a society, what the average standard should be as opposed to, across all countries or across all human beings.
Yeah, I mean, just on the privacy side, I do think it's interesting because I do think this is going to be a flashpoint. I mean, obviously it has been this year, but there are differences between countries. Like, for example, stuff that is considered completely normal in China or even the US to a certain extent, in Germany would be considered horrific and completely illegal because of the history of the country, especially in Eastern Germany. These are things that people take very seriously. But especially on the alternative, you mentioned the satellite images, and that sounds almost innocuous that they can see people. But, I mean, there are virus scanners that people install into their computers. They essentially read your emails. When an email comes in, it sees if that email comes from Amazon or Best Buy or wherever, or, I don't know, like, Northrop, something like that. And if there's an attachment, it realizes that's probably a receipt, so there's cookies that will automatically scan those email receipts, and then will create this sort of instantaneous running measurement of what people are spending money on. So you can put this together with credit card sales and app downloads and get a sort of real-time map of consumer spending. I mean, as a journalist, I think that's really cool and interesting, and if you're a hedge fund manager, that's fantastic. But you get to the point where individual funds have so much data that is aggregated and should be very well scrubbed of personal identifiable information. But I do think this is something that you will reach a tipping point where there's some scandal that's so bad. And I don't think Facebook is that scandal when there will be a backlash. Though, to be fair, there was an example in California a couple of years ago where apparently a baby cam company had baby cams that would film the baby. And people thought this was adorable to see the kid rolling around asleep. But all the videos got put up on the open net, entirely unencrypted. Literally anybody could go in and look at videos of people's babies. And this was a scandal for like a day and a half, and then it died out. But so maybe our threshold for where we draw the line varies from country to country. Maybe it's just higher. Maybe in the 21st century, privacy is just something we give up on. I don't know, but I think that's going to be really interesting. There was a gentleman down here in the blue tie, dark suit. I'm taking your name, so if you give me your hands up, I have an order here. I'll try to get to everybody. Yeah.
Hi, Roger Bliss at MUFG. A couple observations. The first thing in terms of the backlash, at least this current generation of backlash against automated cars, I think it's based on relationship. We have a relationship with one another, right? 45,000 people could die of accidents, but that one individual is probably accountable for that accident, and there's somebody who has a relationship with him. No one has a relationship currently with an automated car, so it's an alien, and we react. So just in terms of why the reaction is different. The second thing is that I would say with regards to the job, I agree with you. I am very bearish because, I thought you were going to go to the horses and humans. That's very scary, right? If there are 17 million horses in the United States and there are only 2, what happens to all these people, even at a low scale? I disagree with you, though. I think we're seeing encroachment into higher skilled. I'm a lawyer by training. There's a lot of legal aspects, even higher level legal stuff that can be now replicated with algorithms. And I think as you see that encroachment, I think you're going to see more backlash with regards to people. You're not going to be safe with advanced degrees in certain areas anymore. I mean, at some point, I would think you could train a machine to do what the quant does. So then where's the next round of new jobs? And I think in absolute numbers, there's going to be less jobs. So who buys the products, right? I mean, a machine buys a product. I mean, our whole economy, the way we think about it, will have to kind of be rethought if you kind of take this out to the end. So just some observations.
Yeah, I mean, I would actually like to ask, because I wonder if this whole automation, I know that I'm worried about it, but we are particularly worried, people, frankly, in this room, because this one is going to be uniquely addressed at high cognitive skill, high skilled people, lawyers, doctors. Think of what a doctor does. Machines can do that a lot better. Some 2 sigma quants trained a machine to identify heart palpitations better than any human doctor. And then did this for fun on the side as a Kaggle competition. And I wonder if like we were just less worried about automation and robotics because, frankly, that was lower skilled people who didn't have as much of a voice as doctors, lawyers, bankers, and journalists. But I mean, I'd like to. I mean, should we be more worried about this? I mean, we're going to move to universal basic income, perhaps?
Oh, absolutely. We need to be worried about it, but we don't need to worry about it quite as much at this point in time as we do
Our
need
children,
to worry at
basically.
5 to 10 years. Exactly.
They can-
Maybe half a generation or a generation later is when these things were. So if you look at a radiologist, I mean, what does a radiologist do? I mean, he or she is scanning X-rays or whatever. CT scans or MRIs, and as you said, machines can be trained to be better at this on average than any given individual radiologist eventually, maybe 5 or 10 years from now. So you're absolutely right, and so the level of job losses will continue to creep higher as time passes into more advanced degree kind of jobs.
I'm less skeptical because the population of the world has increased and the number of unemployed has increased, but relatively less. So with all the advances that have happened historically, if you talked about some of the things 50, 60 years ago on what's happened in industrial factories, in automation, people talked about it like we're talking about this stuff and said, oh my God, there's going to be such a big job loss. We're just not going to be able to absorb it. But the reality is we made it through that. And those technologies were as foreign and as threatening as these technologies are. And so I just think we don't know, but there's going to be other things that are going to, human beings are resilient, and there's other things that we're going to solve for. We're going to be innovative, and that's what's going to, I think, create more innovation to enter into spaces that we've never thought about, right? I mean, it's just going to be, I'm optimistic, and I look forward to that, and I don't think that my kids 20 years from now will have boring universal basic income. I think there'll be much more exciting things for them to work on.
Up in Mars, if Elon gets
Sure,
his way.
space exploration, travel, I mean, colonizing space, right?
So we have a gentleman here in the middle there with the grey jacket and the blue shirt that's got his hand up. Can you get a mic to him?
Hi, I'm Richard Katz. I'm from Toyo Keizai, Japanese business magazine. I have a question about potential application to Japanese banking. And I'm going to try to ask it in a way that you're able to answer it. But one of the biggest problems, well, there's lots of problems in Japan, but one of the biggest problems is you have a dearth of new, growing small and medium enterprises in Japan. And one of the reasons for that is that in Japan, when banks make loans to these small and medium-sized companies, in about 80% of the cases, they insist that the owner pledge his personal assets, including home and everything, as collateral for the loan, which cuts about 20 or 30%. So that's a limit on what people can do, how much they can borrow, and it really puts a limit on the growth. And somebody explained this is basically an information problem. They actually do not really know, partly because of the way the banks are run, but also just for information reasons, how to judge the credit worthiness of this borrower, how to judge the riskiness of the project, the new business they want to do. So the safest and laziest thing to do is just to insist if you don't have the collateral or you don't pledge your personal assets, we're not going to lend you the money. So anybody who needs the money can't get it. If you don't need it, you can't. So my question is, can you imagine a scenario in which AI would be useful in actually allowing these banks to make a better judgment of the credit worthiness, potential cash flow of a project so that more of the loans could be made without this personal guarantee? And in that case, you would actually have the ability of more businesses to get off the ground. Clearly, a lot of them will fail, and your interest rate should cover that. But, and you can adjust different interest rates for different levels of risk. But could you explain to me how AI could help solve this problem? If it could, that would be a tremendous benefit to the real economy.
So, I mean, I could be wrong, but it seems to me like there are two underlying issues here, right? One is the demographics, which and the second is risk aversion, and the risk aversion obviously is quite linked to demographics, at least in a country like Japan, which is one of the most aging populations in the world. If it is indeed risk aversion, thanks to the 80s or 90s problem or whatever, And the fact that we've never really been out of the zero interest rate policy regime for all of these reasons in Japan. I mean, it would seem to me that it's not actually a problem of identifying the right risk. I think it's more of a problem of risk aversion than anything else at this point. And if that is so, if what I'm saying is correct, then MLAI is not going to be able to solve that.
I think it's more of an art than a science.
Yeah.
And I'm talking from personal experience here. I've sat across the table from over 500 investors in our office, and we're not asking banks for loans or anything like that, but we're asking investors to invest in our fund, right? And it might be a similar thing where they're evaluating the experience of the team and how risky, what are the risks associated with these investments and things like that as well. And to be honest, like the only conclusion we've come up with was it's more of an art than a science. Some investors will come in and they'll love our idea and they'll think it's a great fit for them, and then other investors will come up and say that's not a good idea and that they don't like it, and that's totally fine. And so there's, if you look at the, I don't think it could be replaced by AI anytime soon. We've had this discussion before. I remember this now. But I was thinking like with Masayoshi Son with SoftBank, when he invested in Jack Ma of Alibaba, I don't think any AI could have predicted or justified an investment in Jack Ma back then when he had no experience and he got rejected from KFC and got rejected from Harvard. No one wanted to invest in him, and yet he just, if you watch, there's a good video of it, but you watch the video of kind of why he chose to invest in Jack Ma. It's like it was just a gut feeling at the end of the day. And unfortunately for our investors as well, they look at the data, but at the end of the day, they have to make a decision, and sometimes it's just more of an art than a science.
But could we, in a world where we have more data about people that, if you're a bad credit risk, if you're basically, tons in debt, and some people do some bad credit, some companies or people are just risky creditors and others are not. So it's always going to be easier for somebody who has money to borrow money than somebody who doesn't have money. But could we buy through better uses of data and more and less biased algorithms? Like algorithms do have biases, of course, because we embed them as humans, but something that looks beyond the obvious thing that we know that, for example, like in the VC world, men tend to invest in other men. It's just men are terribly bad at that. But we also know, frankly, in access to credit, that there is a discrepancy between how many men get loans. This is certainly in the developing world. Grameen banks have raised awareness about this, but women tend to be better creditors and borrowers than men. Could we actually have a system where maybe people use more AI that sort of strips out some of these biases that we know into the credit decisions?
But Robin, my concern here is that we are not talking about an emerging market. We're talking about a very highly developed market where there is, I'm sure, no shortage of data as things stand right now. There's no shortage of credit scores or credit information on individual borrowers. If we were talking about a country like India or talking about Grameen Bank, talking about Bangladesh or India, then you're absolutely right. Where MLAI can actually overcome some of those obstacles. But here we already have all the data.
Yeah, no, I'm thinking. Obviously the Grameen, that's sort of the extreme low end of this scale. But in the way that we are clearly using more data, credit rating agencies, some of the experience, they actually go into your Facebook page and will judge your credit score based on stuff you say and how many caps you use. So use less exclamation marks and fewer caps locks, basically, is my hit tip. But by using more data that we might be able to look, if a country or a bank or banking system has lots, there'll be more appetite for risk in the US and Japan or in Europe. But actually, by showing people the data, you can show to Japanese bank ABC that actually, if you look at this, our credit risk, these are our losses over these types, these are things that we find correlate, and we should be lending a bit more money to these people because they actually turn out to be pretty good. But I guess, we're not moving towards that?
Well, no, my concern is that,
trumps algos?
Well, that data probably already exists. I think it's more a question of risk aversion, personal risk aversion as a society, as opposed to the existence of data which can actually point out a good credit versus a bad credit.
Yeah, so AI is useful for unstructured data sets, and I guess what you're saying is that most of the data is already structured. It's already there, and so there's no point in having an AI, scan through things when you can just literally click a button and take a look at it, and you have a credit score right there, right?
Exactly.
So yeah, that's a good point.
There was a guy here in the green shirt and glasses in the front. So did you want, yeah? So that'll be probably the last one. Oh, sorry, this guy was first, but I'll go. You'll be the last one, I promise.
Hi, I'm Matt. I'm a computer hacker. And while I have many questions I could ask, I liked the initial callback to history, because in the 1950s, people thought computers were absolutely infallible and the gold standard for any kind of answer, that if the computer said so, well, it's going to be the way it is. You know, Dewey defeats Truman and all the rest of that. It's remarkable to me that the financial industry seems to have taken AI in a completely autonomous way, whereas in medicine, computer-aided diagnostics are there in order to augment the doctor trying to make his diagnosis. What happened to the notion of these applications being developed to assist the trader on the desk to maybe look over his shoulder and prevent the fat finger, pardon me, of the $20 million trade instead of $20 billion? Or say, hey, here's an interesting thing that I've been toying with overnight while you were asleep. Why is it this push towards full automation and black boxes and just like let the machine run in the background and we'll fire the traders?
Oh, no, don't get me wrong. There are many decision support systems that we are currently using and that are in the process of being developed at the, in the banking industry, which will actually help the trader or the salesperson, make that decision. In fact, as I said before, we are a highly regulated industry, and so, we move in, we take small steps. And this is one of the small steps that we are taking. And once, things evolve a few years from now where the trader or the salesperson becomes absolutely comfortable with the algorithm, knows when to buy the market, knows when to short the market, then we can automate some of these things. But absolutely, we have a bunch of decision support systems that are currently in operation.
Yeah, and actually, in practice, how you articulate it is how it's happening, but not because of the way you'd said it. It's partially just because of the slowness of adoption and the worry and losing jobs and all that stuff. By default, it's become an augmented type of capability that people are using to augment current roles as opposed to replace them.
Yeah, it does seem to be. I mean, I lost track of how many people tell me the story about, supercomputers and chess players, that a average chess player, human chess player with an average computer program can beat both a supercomputer and a grandmaster. It's like the man plus machine approach.
That's right.
I always kind of get the impression that people tell me that to make me feel less worried about job losses, but I think we'll have one last question here.
Thank you. Gautam Sakalian with Cognitum, which is a AI platform. Question is that, getting back to the jobs issue, everyone agrees that the job losses are coming. The thing that hasn't really been focused on is, and concerns me, is the actual pace, how fast it is, because things are just changing much faster in the last 2 years than they have in the last 10 or the last 50 years. And do you foresee that at a certain point, like other technologies, where government may step in and try to actually regulate AI? Is that a concept that anyone's looked at, to sort of maybe slow down or have only certain controlled use for AI, and government should intervene so that things don't get out of hand?
So the government, I was actually at the government conference not too long ago, but they're, yes, they're regulating AI in a certain way. They're regulating like the abuses in the marketplace, for instance, that could be facilitated by AI or could just be human. But at the same time, the SEC themselves are using AI themselves to combat it, and I think that's actually really cool. We're all evolving here. They're hiring PhDs in computer science and hackers, to go around and make these innovations and catch the other hackers, out there. And so I think a lot of it is actually, the government is a lot more leaning towards the side of adoption rather than complete rejection and, let's set a time limit or like have barriers and slow down all the high frequency traders or anything like that. I think that idea has been kind of thrown out the window a while back, and now the focus is on how can we all, faster is better in you want your phones to be faster, you want everything else to be faster, and so finance is the same thing. There's so much data, it's better to be faster, to process that data faster, and so now the question is how can we be responsible, and how can the government kind of stay on top of things, and I think that's an interesting question.
Just on the job losses, though, I mean, I remember I talked to them, he was on background, but a head of one of the biggest quant firms, and he was worried about like how quickly skills were becoming obsolete. That, he said we had people who were studying computer science, and by the time they graduate, the stuff they learned in the first 2-3 years is just kind of obsolete already. So he was genuinely worried about the pace of how quickly things were happening. And he said, look, maybe he's just so close to the cold face that he's overly worried about it. But it was an interesting idea that this, and maybe, Gautam, because you seem more optimistic than Pawan, but the pace of this technological disruption, like most other things, have happened over a couple of generations. Exactly. This one's going to happen, seems fairly quickly.
Yeah, I think it'll happen quickly, but I think our ability to transition and learn has also increased, right? So to a factory worker, it was very serious, the pace, and it happened, and it was kind of a similar concept where that factory worker had to adopt to learn new skills. I think our ability to learn new skills and everything that's available to us online, and you don't have to get a college degree anymore, you can go online and learn things, that's also increased, and it's increasing at the same pace, right? And I think that's why I'm optimistic, and I do think that your points are right on in how it'll happen, but I also think that there will be some conversations about, and I've heard it, that should we tax bots? Right? If a bank is going to give a bot a user ID and password and onboard it like an employee, should they pay FICA and pay taxes and do those types of things, right? So I think some of those things will come to bear, and it might slow it down, it might regulate it more, it might protect things more. I think part of the reason why in the US and I would say even in Europe, it's less of a concern because hundreds of thousands of jobs have been outsourced, and the general sense is those are the ones that are going to get eaten into first, right? So we're still somewhat protected and insulated, but the pace will happen quicker, and then that's when some of these other discussions will come to bear.
Or some kind of retraining fund, or putting
That's
up
right.
the
That's right.
government so people can get trained fast.
Yeah, and I actually was involved in a project where the government of Malaysia actually, when I don't know how many of you guys might have heard of this crowd worker concept is out there, right? Where you don't have to go to an office and sit down for a job anymore. You can, at your home, go bid for tasks, and Amazon has one of the largest platforms, MTurk, where you can go bid on tasks to do everything from data entry to reading a very complex document that you need to have a license or pass the bar in the state of Nevada that you might get paid $2,000 for. So the government of Malaysia actually told people that if you're going to apply for unemployment, you're going to spend 2 days a week coming in and doing these crowd tasks on the crowd platform, and that money you earn will offset what we're going to pay you in welfare, right? And so those types of things are going to continue to happen as well, which are all going to be positive changes that can help everyone.
One thing that concerns me before we get to you is just the education pipeline actually does concern me, and it is something I'm bearish on, because if you look at MIT, even today, best tech school supposedly, but computer science isn't a requirement at MIT. But you know what is, you gotta take a semester of chemistry, a semester of biology. Have I ever used bio? No, right? And that's shocking to me, given that a tech school is not, making computer science even a mandatory course. And so that does concern me, because, these students are studying these great majors, and they're great to learn and they're great to know about, but the pipeline is they go into research or they go into med school. And while that's great, you look at other fields like nuclear engineering or, aero-astro and things like that, and there's so many students there, but then at the end, after graduation, where do they go? They go into tech, they go into finance, they have to relearn everything from scratch. And so it is a little concerning to me that, we don't learn computer science in the classroom as nearly as much as we should.
So my view is that, it's a question of which country we are looking at. I'm originally from India, and I would absolutely not put it past some populist government, to institute laws in the country that, slow the development of MLAI just so that they can preserve jobs. It would actually be welcomed in a country like India. In a country like the US, now you can certainly see a situation where, because of
no
privacy...
populist has ever won elected power.
In a country like the US, you obviously cannot say that, the reason why you're trying to regulate MLAI is because of job losses. Now you can have, things like privacy issues, which are very valid issues for a lot of people. But to say that you're going to start to regulate MLAI because of the impact on jobs is just not going to fly in a developed market, especially in a higher and fire society like ours.
On that note, I think we're going to draw a line under it. So, Christina, Parvan, and Gautam, thanks so much. This has been really interesting. If you put your hands together, please. Sadly, I have to run immediately afterwards. I think you guys are staying for the drinks, but my email is robin.wigglesworth@ft.com. It's a weird last name, but it's on the program. So just, if you have any questions for me, perish the thought, then just email me, and I'll try and get to them as soon as possible.
Robin.